Hello my fellow investors, and welcome back to another stock analysis video as well as earnings report as well. Today guys, let's actually take a look at the company that was brought up by KLL, where she pretty much just said, are you still taking viewer requests? I was wondering if you could do an analysis on AQN. So this was asked 2 weeks ago. I am so terribly sorry I just got to this now, but I figured, you know what, now it's a good time to do it since, well, there was actually a massive movement as of like recently when it came to this company. So let's take a look at their earnings guys as well as their fundamentals to see if maybe at this current moment we would like to buy into this company. So with that said, let's get started with this analysis. And as I just said, they did have earnings on November 11th. EPS normalized actual came in at 11 cents, which was a miss by 5 cents. The EPS gap actual came in at negative 29 cents, which was a miss by 46 cents. That's massive. And the revenue actual was $666.7 million, which was a beat by almost $72 million. And with that said, let's actually jump now into the earnings report. Now, as always, I will have this link in the description below if you guys would like to read it for yourselves. I will only skim through it and only take a few points of note. But we're going to start off with none other than the CEO's comments. We got here, quote, "It was a challenging third quarter despite year-over-year growth in adjusted EBITDA. Our results for the quarter came in below our expectations, yikes, and were negatively impacted by increasing interest rates." Oh boy, that is interesting. "And the timing of tax incentives related to a certain renewable energy projects. Our underlying business remains strong. However, we are not immune to macroeconomic environment. Our team is focused on identifying and implementing the necessary adjustments while executing on our 3 pillars of growth, operational excellence, and sustainability to drive shareholder value over the long term," said Arun Bankskoda, president and CEO of AQN. Continues to say, quote, "Although our earnings were challenged this past quarter, AQN took important strides executing on our growth objectives across both the regulated and renewable sides of our business. On the regulated side, we are one step closer to completing the pending Kentucky Power acquisition." Okay, so that's good. They're making an acquisition apparently based on Kentucky Power, which is expected to add to our rate base, grow customer connections, and provide an opportunity to be part of the energy transition in Kentucky. The signing of our inaugural asset, so sorry, I don't know how to specifically say that word, asset recycling transaction demonstrates the potential value of our existing renewable energy portfolio and greenfield pipeline. Continue to be excited about the prospects of our assets recycling program for 2023 and beyond. Wow, that was a mouthful, but definitely something to know here, guys, is that they got beaten up hard. So let's actually take a look at some of these highlights. We got here adjusted EBITDA, $276.1 million, an increase of 10% compared to the third quarter of 2021. Adjusted net earnings of $73.5 million was a decrease, unfortunately, by 25% compared to the third quarter of 2021. Adjusted earnings was also negatively impacted. That is just really, really bad overall. The company also had lower year-over-year recognition investment tax credits and production tax credits of $17.1 million, and adjusted earnings per common share of $11 decreased by 27% compared to the third quarter of 2021. So let's actually compare some of these numbers, right? So we got here, guys, the revenue, $528 million in 2021 to 666.7, so that was a beat, awesome, increased by 26%. However, net earnings came in, well, they actually went even further into the negatives. 2021 it was negative 28 million, and then 2022 almost negative 200 million. That's massive. That is a decrease of 600%. Cash provided by operating activities, this one fell by 41%, $174.7 million to almost $103 million. Adjusted earnings, 97.6 to 73.5, decrease of 25%. Adjusted EBITDA rose by 10%, $252 million to $276.1 million. Adjusted funds from operations, $170.2 to $205.5, increase of 21%. And dividends per common share, guys, rose by, well, 6%, 17 cents to 18 cents in 1 year. Now, this dividend is actually a little bit concerning, mainly because of their payout ratio. We're going to take a look at that in just 1 second, but unfortunately, this dividend being mentioned here is the only one that comes up in this whole entire page, and that's important because of what I'm about to show you guys right now. So let's move over now into the fundamentals, guys, to see what we can actually learn from this. So we're here in the book value calculator, guys, because utility companies don't have cash from operations, they don't have free cash flow, so we're gonna have to use a book value and tangible book value analysis on this company. So we got the ticker symbol for AQN, market cap of almost $7 billion, a PE of NA, which is very, very concerning. The current share price is only $7.55. Taking a look at this graph, guys, on the 1 year, this is actually insane. They're down 44.32% on the 1 year, and the year to date 47.39%. 52-week ranges is $7.25 to $16. So we're definitely at that 52-week low. Now, what is interesting about all of this is that, well, just about a month ago, guys, they were at around $11.55. However, something happened here that, well, actually, not even something happened. It was because of earnings that they actually fell from $11.51 all the way down. So you can see that was a massive decrease just because when those earnings came out. So you can clearly see right here, it was on the 11th when it occurred. So it is what it is. Definitely those earnings were a major hit to them. They do pay out a dividend of 72 cents per annual dividends per share, which ends up being $490.25 million being paid out in dividends every single year, which becomes almost a 10% yield. To be exact, is around 9.6%. Payout ratio, and this is the part that concerns me the most, 101.86%. That is massive. Now, that could either be really good or really bad. My reasoning is, well, they are a utility company, and utility companies play by completely different rules, right? So for all we know, similar to as to how REITs are mandated to give out 90% minimum of their earnings in the form of a dividend, well, utilities, at least this utility, may have something similar when it comes to them. So definitely something to do more research on this, because this payout ratio is a little bit concerning. The 5-year CAGR is also massive at 9.07% and 9 consecutive years of dividend payment. And for all those of you guys who may like to invest into this company, their ex-dividend day is actually coming up on the 29th of December. Payout date is actually going to be on the 13th of January, and they do pay their dividends quarterly. So now let's come into the fundamentals, starting of course with the net income. 5 years ago of 101.7 million to today of 38 million. You can see massive just increase from 5 to 2 years ago, and then after 2 years ago it just completely collapsed. So that's concerning. They did say that they did have macroeconomics this year, but guys, I mean, look at this. 1 year ago, interest rates were not this high 1 year ago. So why did they drop from 782.5 million to $265 million? Definitely something to do more research on. But for this reason, I'm going to give this like a 35%. Coming now into the total revenue, this was actually looking fairly good. 5 years ago of 1.5 billion to today of 2.6 billion, increase of 72%. Now from 5 to 2 years ago, fairly consistent. Then 2 years ago to today, they started increasing. Not bad. So for that reason, I'm going to give this a 75%. Coming now into the shares outstanding. This one, however, it is just utter garbage. Oh dear Lord. 5 years ago of 431.8 million shares to today of 680.9 million shares. That is an increase, guys, of 57.7% on the 5 year and another 1.32% increase on the 1 year to today. Guys, share dilution, it is the silent killer when it comes to investing. You want a company to be buying back shares, not this. So unfortunately, as it currently stands when it comes to this company, I essentially have to give this a 0% because there hasn't been a single year where they have bought back any shares. Coming now into the total assets minus the total liabilities, as of today, they're at $7.1 billion. And as you can see, this was a really nice steady increase overall. Average total assets is 12.7 billion. Average liabilities is 7.25 billion. Doing this difference, we get $5.5 billion. I'm going to give this, guys, essentially like a 90%, mainly because this year for them isn't over yet. So this current value could definitely get significantly higher than 1 year ago. But as it currently stands, it's still not above it, so I'm going to give them 90%. So looking at the overall grade, guys, I would actually like to take something back because I did take a look at other utility companies, specifically when it comes to the shares outstanding, and actually saw that, well, majority of them, actually all of them, are issuing shares. So that's might be a industry kind of thing to do, right? So if that's the case, which I'm like 90% certain that that is the case, that's not necessarily a bad thing. So that's the reason why I'm actually changing the shares outstanding now to 30%. The reason why I'm giving it still a 30% is because there are two companies that I actually invest in when it comes to a utility company, and they've only increased shares in the past 5 years of only 5%. So this one in 5 years increased it by over 50. So that's why I'm essentially giving it still a 30%, even though it's still not a zero. But nonetheless, guys, we gave the net income a 35%, revenue 75%, shares outstanding, I switched it now to 30% for the reasons I just said, and the assets minus liabilities of 90% for an overall grade of 54%. So they definitely need to just fix, guys, their net income. Honestly, that's really it, and maybe decrease that share dilution by a little bit, at least bring it under 30% on the past 5 years. At least this is what I personally think, but the main issue is definitely that net income is just way too sporadic for me to actually fall in love with this. And now coming into the actual valuation numbers. Going into the book value, guys, this is mainly taking the assets minus the liabilities and then dividing that by the current shares outstanding. So doing this, guys, we get a current book value per share of $7.58, which was an increase of 29% in the past 5 years. And now looking at the tangible book value, which essentially is the book value except removing all the things that aren't tangible, all the assets that aren't tangible, we get a much more better representation of what the company should actually be worth. And a lot of people actually find this to be even more accurate than that of the book value. And doing this, guys, we get $5.54, increase of 56% on the 5 year, going from $3.54 to $5.54. So now let's actually take a look at the current book value and the tangible book value and actually see what the price compared to these values actually are. This ratio is going to tell us whether or not the company is undervalued, at value, and overvalued. So the closest to 1, guys, you are essentially getting at value. Under 1, we are undervalued, and over 1, we're overvalued. So doing the price divided by the current book value, well, we get the ratio of 1.00. So based off of the book value is telling me that this is at price. However, based off of the tangible book value, it's still telling me that we are still a little bit overpriced by around 0.36. So take this as a kind of nudge as to where you might think this company should be valued at. Probably between $5.54 to $7.58 might be the actual true answer, but some people may actually find that the current share price is actually not too bad, right? When it comes to book value, this one, there's no assumptions to be made. It's just mainly looking at these two things. Even though, guys, there are no assumptions, please still have these calculators. They're available for free. Anybody could have them. The book value one, the discounted free cash flow, as well as re-evaluation, and even a dividend tracking sheet, which I just put out a video exactly how to set it up. It is a multi-step thing. Unfortunately, you have to go into another YouTuber's YouTube channel in order to get this macro. However, if you guys are able to set it up, you guys can essentially just have mine for free, and I think it's pretty handy in my personal opinion. So please have all of these calculators, guys. All I'm asking for in return is just like, subscribe, comment. It really does help with the algorithm on YouTube. Thank you so much for everybody who have subscribed. As if I'm recording this, we're up to 1,600 plus subscribers. What is happening? What is happening? 400 more and 2,000. I don't even know what I'm going to do for 2,000. I don't even know what I'm going to do for 2,000, guys. This is absolutely insane. Thank you all so much. I really do appreciate it. That's why I'm more than happy to give out free content, free calculators. You know, I really just am. So, and also, on the 13th, I do plan on live streaming. So if you guys want to stop by, it'll be right before CPI comes out. It'll be, I don't know, I'll probably be live streaming around like 8 a.m., maybe 7:45 a.m. So yeah, if you guys want to stop by and chat, yeah, we absolutely can while we wait for the infamous CPI numbers. So again, thank you all so much for subscribing, guys, commenting. It really does help, and I really do appreciate it. But let's actually take a look now at this dividend, because 72 cents may not be a lot. However, the share price is really small. So putting in $5,725, this nets you, guys, look here, take a look at this. This nets you an annual dividend of $546. That is insane. Absolutely insane. Quarterly dividends of $136.50 and a monthly dividend of $45.50. Now, invest in this company for its dividend if you want to. Again, the payout ratio is high, but they may have something in their earnings or in their 10K that mentions something about the dividend being a specific amount. Similar to like Zim, they're like, oh yeah, we're going to put in 30% of our net income or whatever they do, right? They may have something similar. I don't necessarily know. Definitely something to do more research. I'm cautious when it comes to that payout ratio, but if there is an explanation to it, then you might want to consider buying this company for its dividend also. All in all, thank you so much, KLL, for the stock recommendation. It was interesting. It really, really was. I just think that they mainly have to fix that net income. Honestly, if they were to fix that net income and if it was still like at $7 or something like that, oh my god, that would be absolutely crazy. But as it currently stands, that net income is really, really killing me. Anyways, that pretty much does it for this video, everybody. Like if you like, comment, subscribe. It really does help over the algorithm on YouTube. You guys can follow me on my new tech sites. A link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video as well as earnings report.